All right, well, welcome back to the iWealth podcast. We're joined by Mr. Brad Connors today, and today we're talking about paying taxes and when you should do it, if you should do it, yeah, and kind of some of the strategies that go along with the big tax question. So talk me through kind of some of the strategies that your clients use, what works, what doesn't work.
Yeah, so there's different ways to invest from a tax standpoint. So what I mean is there's after-tax money, so money that's in your bank account. You got paid a paycheck. You already had taxes taken out. It's in your bank account. You've already paid taxes on that, right?
Yep.
So that money can sit in an after-tax account, and anything it earns you, whether it's in a bank or an investment, you'll pay taxes on as you go. And so if it's $100,000 a day and 10 years from now it's 150,
if you go to sell that investment,
right, when
then
you go
pay
to sell
taxes
it.
on it.
Correct. And so that's an after-tax investment. And then you also have pre-tax investments, which would be like your 401k.
Yep.
So if you make $50,000 and you put 10% in, $5,000 is going into your 401k.
Yep.
Pre-tax.
Yep.
So you're only going to pay taxes on $45,000 of income. However, someday you're going to retire. And the government forces you to take that money out starting at the age of 72 now. It used to be 70 and a half. It's called RMD, Required Minimum Distribution. But now it's at age 72 that you have to start pulling that out. So they want their taxes, and they're going to get it.
Yep.
And when you die, if there's money left, your family then is going to inherit it. And they have to take that money out over a 10-year period and pay all the taxes on it. So we've established two different buckets of money, one that is already taxed, one that is pre-taxed, and then you have a Roth IRA, which is a tax-free bucket, a tax-never bucket. And so you take the money out of your bank account that you've already paid taxes on, you fund a Roth IRA, and anything it grows down the road you don't pay any taxes on, and that's a Roth IRA. Can't touch it till you're 59 and a half. There's a couple nuances for first-time home buyers in college and things like that too. So it really comes down to like which one do you use, or should it be all three, or how does that work? And then there's Roth 401ks, and so you can defer into a Roth 401k, and you can do a pre-tax, and it gets pretty complicated. So you really have to pull out that tax returns. We did a podcast earlier about why we need to see the tax returns. A lot of that tax return and that bottom line of what you're paying for taxes has to figure into this conversation. And I'll have some clients that are just totally convinced that taxes are going up. Like we're in the lowest bracket we've ever been in. And I have some CPAs, by the way, are convinced about that.
Sure.
And so they're in a moderate tax bracket today. They're not in the lowest, but they're paying taxes today so that they don't have to pay it down the road. They're doing Roth 401ks and things like that because they believe when they retire that taxes are going to be higher. They're going to be in a higher bracket.
Yep.
And so why not pay them today and then down the road? So a lot of different things. There's people's philosophy on taxes and government spending based on taxes, and all those things kind of factor in. And then we go to a business owner. And so a lot of business owners will do like a SEP IRA or a simple IRA or an individual 401k. And what's really neat about it is let's just pick on a farmer. So let's say a farmer has a really good year in the fields, okay?
Yep.
Like last year, they had a really good year. They could come in and they could fund a SEP IRA for 2020. And they can do that after the fact. So the year's done. They know that they've did a nice job with their farming operation, and they put $25,000 in this SEP IRA. Okay. It's like buying a $25,000 tractor to them, and they write it off, and they have less income taxes due this year. Now, someday they're going to retire, and they're going to have to pay taxes on that 25, correct?
Yep.
However, let's say that we go 5 years down the road, and they have a tough year in farming.
Yep.
And they don't have the same earnings, and now they're in a really low tax bracket. What we'll do is we'll go back to that SEP IRA, that $25,000, and we might convert it to a Roth, because you can convert IRAs to Roth. It becomes income. So now let's assume there was no growth on that. The $25,000 is still $25,000. We convert that back to a Roth. They're in a low tax bracket because they had a tough year in farming, or they bought a big piece of equipment and had low income or whatever.
Yep.
Now that money is in a tax never bucket forever. So now at $25,000,
which is like the sweetest place to have it.
Right. And so a business owner, not just farmers, but a business owner based upon their income, can control this a little bit.
Yeah.
But they need to work with their advisor.
Tool.
Correct. But they need to work with their advisor. They need to work with their tax advisor. They've got to be smart about it. But there are some tools out there, and there's not one size fits all with these buckets we keep talking about. So it's confusing. I'm sorry about that. But you just need to know enough to ask the right questions with whoever you're working with.
Yeah.
To try to get some help. Just try some discovery.
And I think it's probably we're saying if you're sitting out there and you're going, you lost me at term number 4 here. I actually think as we're saying, then put it in the comments below. Somebody from iWealth will happily reach out to you, and they'll spend a little time with you figuring out the scenario that's specific to you, whether you're a business owner is kind of not, you can almost say wildly different than if you're an employee. Right. So somebody will reach out to you and they'll sit with you face to face, toe to toe.
Yeah.
And figure out your situation.
Yeah, I think it's really important. If they need some clarification, just send us a note or give us a call or put it in underneath a video or something like that, and we can get back to them. But the main thing is to understand that there's differences, and there's different times to use the different tools, and you just have to figure it out. And you got to have somebody help you if you can't figure it out yourself. It's not overly complicated, but somebody's got to think through these different scenarios. Sure. And I think that's part of the reason why we get paid, to ask those questions and to be able to help people kind of through that situation. Yeah,
I just heard about a business owner the other day that they have a healthy business, and then they got a big, huge, somebody had passed away in their family and had given them a bunch of money, and just the different strategy plays that go along with that and kind of how you're choosing to use it. This business owner was sitting there telling me, well, I could do it this way, and about scenario number 6, then my brain was ready to explode. But that's where having people like you guys that can kind of help play out those different scenarios can be so helpful.
Yeah, and a lot of time it's several people on your team. Like I said, it's your accountant, your financial advisor, your lawyer. There's different times where they have to play those roles and work together and things like that. So,
and that's part of the beauty of the other thing too, that oftentimes we've talked about, where you pull the team together, once or twice a year, or even sometimes more often, depending on the level of complicated that your financial world is. But pulling that team together a little bit to look at what's happening here in the next quarter or the next kind of season that you're coming into.
Yep. Whenever there's life events and those things going on, you just need to check in with somebody and make sure that you're getting some help.
Very cool. Well, we'll see you back here sooner rather than later.
All right. Thanks, Matt.
All right, bye.